Hi there, welcome back to First Trades. We've been talking about equity markets for so long, but let's just focus and talk about some fixed income securities. What happens to the bond market right now? So much at play in terms of GST, in terms of the US dollar index. Let's understand that and much more. We have Mr. Mahendra Jajoo, CIO, Fixed Income at Mirae Asset Mutual Fund, joining us on the show. And hi, Mr. Jajoo, good morning. First up, help us understand the impact of GST rationalization that we're expecting to see on bonds, because lower fiscal revenues and borrowing needs will be going up. What would be your assessment of any potential crowding out effect on the bond market due to increased borrowing needs? If you could just help us understand on that front.
So I think it's fairly intuitive that if there is a GST rate rationalization, there would be some impact on the fiscal deficit because there will be that much less revenue collection. But if you look at the overall, mathematics of the budget numbers this year, we have had a bumper dividend from the Reserve Bank, which is much higher than what was budgeted. The GST collections so far have been robust. So there are two parts to the relief that the government is planning to give on account of GST. One is that the GST collection itself has been very, very robust, and therefore the government is in a position to pass on the benefit of better compliance to the direct consumers. And then there are other sources of revenue. For example, I talked about the RBI dividend, but there is also the PSU enterprise dividend, which is very robust in the current year. And then there is a argument which many analysts are making, that for now maybe the focus should be on consumption oriented fiscal measures than the capex oriented fiscal measures. And to that extent, there is a possibility of reallocating from out of the capex budget onto the consumption budget. So therefore, there would be some impact on the fisc, but I don't think it is substantial enough. The broad indications which many analysts have worked out is impact of maybe from 0.2% to maybe 0.06% on the fiscal for the current year. So I think from the bond market perspective, it's not a very substantial number. In absolute numbers, the borrowings could be higher maybe by 25 to 50,000 crores, which on such a large base is not something. So therefore, the GST rationalization by itself is not something which is a driving factor or the central theme for the bond markets at the moment. There are other factors which are bothering the bond markets and not necessarily the GST change, which is at the margin.
Hi, good morning, Mr. Jajoo. This is Shrishti also joining in. You helped us analyze the factors that could be at play, but overall, how do you see the bond yields moving from here on? Could there be some upward pressure on the bond yields, particularly in the long-term curve?
So we have already had a fairly, bearish sentiment in the bond market since the last policy, in spite of a 50 basis points rate cut by the Reserve Bank and commitment to reduce CRR, which is kick in from the next month in 4 tranches by another 1%. In spite of the massive liquidity in the system, the 10-year yield has crossed 6.5% as we speak, from a bottom of 6.15% or thereabouts in the prelude to the June policy. So the market has itself corrected already by close to 35 basis points, which is huge. So from here on, I don't see a significant upward pressure on the long-term yields. Maybe it will move in a very narrow range, but at the same time, clearly the momentum for the bond yields to come down at the moment is not there. So our best hope is that the bond yields don't go up. I don't think that there is a massive upside also in the yields. So the market should now remain in a range, not getting any encouragement from the policy side anymore. There is no tailwind from the regulatory side or from the policy side to the bond yields to come down. At the same time, I think India's macro fundamentals are so strong. The inflation is at close to a decade low. The monsoon has been good. Therefore, I don't see any reason for the bond yields to go up. We are therefore in a very tight range market where uh, there is neither the driver for the yields to go up or come down in a meaningful way from the current levels.
Sure. Mr. Jajoo, let's move away from bonds. Since you're not seeing any incremental uptick in the bond yield from here on, let's just focus and talk about what the RBI might do next. Now, with inflation trending well below RBI's midpoint target, is there room for a rate cut, or will the central bank continue to remain cautious? And the second question here is there a need for a rate cut? Now that we also have the GST fillip coming in, what's your take on that front?
Yeah, so I mean, looking at it from the RBI's perspective, clearly from the domestic factors alone, there is a need and scope for the rate cuts both. Need because everyone is expecting that the economic momentum will slow down. You know, at the moment, the GDP growth projections have not been revised downwards, but we know that the maximum downward happens towards the back end of the calendar year or the financial year. So one can expect the economic momentum to slow down. All the high speed indicators are suggesting that the momentum is slowing down. The RBI, therefore, from a domestic perspective, needs to support growth more. The inflation is at a decade low. It's close to 1.5% now. Maybe with the adverse base effect and some rebound in the agri prices in the next quarter or so, maybe the inflation can go back to 3.5-4% band, but still that leaves room for the Reserve Bank to cut rates. So purely from a domestic evaluation, there is need and scope both for the rate cuts, but it's the external factors which are, I think, holding back the Reserve Bank. We are seeing the global bond yields continuing to inch up. For example, in US, the yield curve has steepened significantly in spite of Fed having cut rates already a couple of times, and with expectations building up for the Fed to cut rates more. There is not much of the excitement at the longer end of the curve because there are concerns on the higher inflation and higher fiscal deficit because of the domestic factors specific to US, and similar story across the globe. So therefore, the bond markets in general globally are trying to reset the term structure, as we say in the bond market language, of the yield curves across the globe, steepening trend, and therefore the differential between Indian long-term bond yields and the global bond yields from a historical perspective have narrowed to a very, very small level. So, for example, the difference between the 10-year bond yield in US and in India was below 200 basis points for a long period of time. Now, that difference has narrowed because of the improving fundamentals of India and deteriorating fundamentals of US, for example. But then I think it has reached a point below which it may not be sustainable because we are beginning to see a sustained outflow on the FPI side. We have seen sustained outflow on the equity side. Bond flows have also been negative from the FPIs for some time now. Last couple of months, we have seen small uptick. So therefore, I think it's the external sector which is not going to allow the rate cuts to happen. And therefore, you see the correct stance of the Reserve Bank, as I understand it. Their focus is on, therefore, transmission of the rate cuts that have already been happened to the broader market. There is focus on transmission of the rate cuts and the liquidity injection into the bank lending rates, bank deposit rates. And I think that's where it's going to be focused for now.
Indeed, indeed. But thank you so much, Mr. Jajoo, for taking the time out and speaking with us and helping us understand that if at all these new GST rates get applied and what rate, what could it really mean for the government's borrowing plan and what sort of a movement is expected on the bond yields. But time now to slip into a very short break. Don't go anywhere. We'll be right back after this quick break.